All right, check, check, radio check. I want to thank everybody for taking time out of their busy schedules. It is now 4:30 Apple time. If somebody wouldn't mind putting into chat that you can hear me, you can see me, we don't have any technical issues, and we'll go ahead and get started. Perfect. Thank you. All right. So, again, this is our market update. And if you've not been on a market update, and you're joining us for the first time or for a refresher, so even though it says May 2026, we are doing a rear view mirror look of what's happened in the past last month. So a lot of this data is from April or trailing 12 month. So, we'll start off with asset class, right? So we're looking at, what's going on in the economy and we see baby blue commodities is just come back with a surgence. And, not surprisingly, commodities are tied to fuel, petroleum, energy, and precious metals, right, which are in high demand, right? So, and then you see pink, I think, in green, we see emerging markets in green, and then, U.S. Treasuries. Typically, they're at the bottom and they were a flight to safety. So, this map is just sort of reflective of, what the consensus is from a, investor sentiment standpoint. But what's really just mind-blowing is you look at the S&P, mid-April to now, with the, Iran conflict, you have really, a lot of stress, but almost a complete reversal. So it's, really it's been the best month since November of 2020. And then if we start to get into the equities, now we start to look up, all the different indexes. And on the left side is our monthly chart, right? And you can see that the NASDAQ up 15%. And so that's just, that's AI, anything technological, technology related. And then you have emerging markets, right? So emerging markets, think about, Taiwan, South Korea, Brazil are leading the charge because they are building a lot of semiconductors and chips and things of that nature. So, it's really sort of interesting because I think back a few years ago where, we were seeing the complete opposite, right? Emerging markets were not the place to be. But, that's the one thing about, investing and being in different sectors and spreading and diversifying. This is how you're able to reap the benefits. But as we look at growth versus value, now these lines here, just for a point of reference, you'll see that they're either gold or purple, and then there's a light gold and a light purple. And so basically, what it's saying is let's say the light gold is growth, and the growth is beating value stock. But what's really being, is evidence is the small caps. So when you look at the Russell 1000, that's really sort of a lot of the same holdings that are within, say, the S&P. But if you look at the 2000 growth, right, so that is more of your mom and pops, smaller companies, and they are starting to get their win. So that did very well. Versus, we look at some of the purples here, both the if you see here at the top. Right. So the 2000, which is total return for value, is still winning, trailing 12 month, but the purple behind it, the small caps, have not done as well, right, in the value section. But if you look at the for the trailing 12 months, if you look at the growth of the total return, the 2000, which is the again is the small businesses of America, and me personally, I feel this is like the heart, the lifeblood of America is mom and pops, Main Street, those stores that we go to locally in all of our communities. I think we need to support them, and they are winning right now. So, then again, you can see that, as you start to mirror the S&P, then, the growth is obviously more aligned because some of those bigger stocks and holdings are in that format. The next chart, let's see. Hopefully I didn't. There we go. Domestic sectors, and again, left side technology, right? It is technology. We know that April. It is just it's winning the day. But then you look over and you see, just a squiggly line. But if you look at that dark green and you see that, hey, listen, the energy sector right here, that's winning the day. And that makes sense, but it did pull back, right? Because that with the conflict, right, we did start to see that pullback. But then right next to it is we have the tech sector. So between energy and tech right now, they are the winners. And even then we have emerging markets, right? So we have this light green, we have the industrial sector. So the key here is when we're thinking about investing, and if you're doing this on your own or whether you have a 401k at work, sector rotation, you'll hear that a lot of times saying, hey, what's hot and what's not. And right now, healthcare and consumer staples are not doing as well, but all things seem to be in the green or in the black, depending on your color of choice. So again, just all good positive news here. So domestic sector. And these are specifics, specific stocks that have gone up, and it's mostly technological and information, right? The only one that was in there was healthcare, Centene. Centene is healthcare organization which relies heavily on government subsidies. So the rest of the health care sector, not so much. And then if you look at what's down, right, you have some of those things that we mentioned before, the healthcare sector, some of the consumer driven areas. And think about it, people, are concerned with, inflation. We're going to get to that in a second. Things are more expensive. So if we're using items in our day-to-day lives, right, those are our consumer staples, but healthcare. But from an investor standpoint, money tends to leave one sector to go to another. So just because things are down doesn't necessarily mean that the companies are down. It just means that money is flowing typically into other areas from an institutional level. So just keep that in mind. Now, the economic data, right? So we're employment. So employment continues to sort of be level right now. And although it's really more manageable. It's still not ideal. But basically it's just saying that, hey, everybody that is looking for a job um, can find a job, but we are off its highs. So, although there's I think it's better than the spike where we had people that were really 2020 when COVID hit, were looking for work, or maybe they were just taking a pause for a little while as we figured all that out. Right now, it's sort of flat. And so that's actually good news for the economy. Inflation, right? So we have three things here. We have inflation, core, and consumer price index. As we look at inflation, right, we want to make sure, things are more expensive at the grocery store. We know that. And then as normal inflation, typically the Fed wants it to be around 2%. Core inflation removes food and energy from the equation. And then the producer price index, that's more like what a business will pay for something. So as we're looking at this, we're still inflation is still there. It's not as curtailed. So when the Fed is looking to, and that's one of the levers that it can move, it can either raise or lower interest rates. And right now, we still have Jerome Powell. Last week, he elected to keep rates the same. And so this is all sort of as we go real time, we're just looking back and we're going, this is not horrible news, right? It's still higher than it has been, depending on what happens in Iran and in the Straits could affect things. But I know that prices at the pump are more expensive, but they're not anything that I think long term are going to make a significant difference. But when it comes to manufacturing and producer, like if you're a business buying items and stuff or transporting items or getting things out into the public, right? Fuel is obviously higher. We already know jet fuel. We lost an airline last week. And again, I'm still talking about April, but all this stuff is moving real time. So as we think about it, things are more expensive. We know that. So consumers, though, are still showing confidence in the economy. So they're still spending money, they're still traveling, they're still buying things. So although things are a little more expensive, yes, we would like, and you're going to see this on the next slide, we want housing prices, right? We want them to come down, but they're, the existing medium home sales about 408, that's about flat, and then new homes, right? And there's a couple reasons for that, right? There's less inventory, right? So that always is going to keep prices high, but also the cost to borrow. I just had a client that retired last week from Rutgers and is moving down to South Carolina. And, they had to get a new mortgage. And yes, it's north of 6%. It's not perfect compared to 2, 3, 4 years ago, right? When we were in the twos and threes. But now we're in the sixes, and but at least we're not in the eights anymore. So I think that we will continue to see as the economy starts to figure this out, we will see housing prices. If you're selling, you want as much as you can get. When you're buying, you want it as low as you can get. But even if you buy an expensive home, what really helps you to purchase that is when rates drop. So everybody's watching that, but I think overall this is not horrible news as well. Now, services and manufacturing, this is just a sector, again, predominantly anything above 50 just means we're in the right direction. So the manufacturing side has gotten above 50, which I mentioned last month, and that's good and it's staying there. And that means that we're bringing more jobs back to America, which is, I think, just healthy, right? Just overall, I think we've spent way too much time thinking about kumbaya, let's ship everything overseas and everything will be better if we do. And I think we're starting to find some hard lessons that that's not necessarily true. But primarily, the U.S. is a service-related economy, and so that's still north. And I think that just all leads to good signs, a positive heartbeat for the economy, in my opinion. And then a magnificent month, right? You look at the top seven, everything's just doing well. The Alphabet, Google and Amazon, and this is all tech sector. I mean, everybody is excited about AI, where it's going to land. I think we're in its infancy. I think that I know I'm starting to use it pretty regularly for just questions. But as industries are starting to figure this out, as companies and businesses and consumers are starting to figure out how to use this in a meaningful fashion, I think we will continue to see growth. I do believe we're heading in a very positive direction as an economy. We're bringing manufacture back on shore, and I think all these companies that are tech related are very, very interested in helping that infrastructure and pouring money into that. And I think we'll all be rewarded with that in this sector. Fixed income, again, good news, right? So overall, longer term yields are higher than short term. We have more of what they call a standard yield curve, which means that shorter term interest rates, it's you get paid less for lending money for a shorter time frame than if you go out longer time frames, right? So that's what this chart is just basically saying. And that just compared to a few years ago, we had an inverted yield curve. And what that means is that you could lend money at a higher interest rate than the longer bond time frames typically associated with mortgages or 10-year, 20-year notes. So with that said, I think that if you're basing your income on some type of yield from longer term investments, right, mutual bonds or things of that nature, right, we're seeing that the positivity of that, and that's reflected on this slide, that high yield corporate bonds are up 1.5%, right, and then the trailing 12 month, right, that's virtually flat. But everything else was positive. So the treasuries were the only one under pressure, which is really just very tight, right? And that's where typically a flight to safety. But everything else is saying, hey, listen, if you as a consumer are lending money to businesses or governments or municipalities, right, that you are getting yield, and that yield is what helps us to create income while you're in retirement. And this is just again sort of supporting the argument that our economy is healthy. Things are moving in a good direction. I'm very excited about where I think we're going. Obviously, we want the conflict to end, but and get back to business at hand and start to reinforce what we're doing here and have we're coming up on our 250 birthday. So that's important. And then I think that's at the end. I wanted two things I want to point out. I just finished up my Social Security workshops at Rutgers. So they went very well. This Saturday, I'm doing a community shredding event. So if you're in the area, you have some old documents, you want to shred between 9 and 12 at the Allentown High School in the senior parking lot, we'll be there. Bring yourself, no electronics, no metals, right? So, I mean, paper clips and staples, those are fine, but don't bring three-ring binders because you'll have to take the paper out. But I know that when I close my office, I have 30 years of data that I need to shred because we're basically everything is now in the cloud and stored online. So the old way of doing it and disposing of it properly, that's why we're doing is giving back to the community. That's the first thing. Second thing I want to make sure everybody knows. If your mother is still around, if you have a mother in your family, you're married, or you have a daughter that is a mother of your grandchildren, just have a very wonderful and blessed Mother's Day, right? So, guys, I want to thank everybody for being on the call. If you guys need anything, let me know, and we're always a phone call away. Lastly, we have one more event that's going to be June 9th and 11th. That'll be our last one for the first half of the year, and that's really going to be on the principles of retirement. And if you want to attend that before we send out mailers, just send us an email. Love to see you. So here's our disclaimer. Everybody have a great day. Happy Mother's Day to everybody, and thank you for attending.